Jim, Aurora Cannabis is real money stock of the day. They just added Nelson Peltz as an advisor.
I know Nelson very long. Nelson is the expert in consumer products. Nelson on the board of Procter. Nelson used to be on the board of Heinz. This is the endorsement that Aurora needs to be able to put it in big time. Aurora has a market cap of $8 billion, moving up. Fiscal sales was for 2019, 232 estimate. Okay, 232 million. Compare that to Tilray for 2019, 193. Kronos, which of course is big stake of Altria, they are only going to have 85 million. And then the big daddy, the one that is valued the most, is $16 billion, is Canopy. That's because of Constellation. Remember, we had at the teach-in, we had Bill Newlands from Constellation, and we had Bruce Linton, and they're supposed to have sales of 184 million. So what you have is a company that's undervalued.
Undervalued. Now, should we be worried that...
Versus the others.
Should we be worried that Nelson Peltz, who is known as an activist investor, is joining the board?
No. Nelson is a guy who really helps. A lot of people on the Procter board tell me very good things that since he joined the Procter board in that brutal proxy fight. So maybe, look, the consumer packaged goods companies have to start doing more in cannabis. We know that Coke and Pepsi are not interested. We know that the Vice squads are. It's all Vice, right? Tobacco's interested. Beer's interested. They're trying to cover their flanks. Neither Coke nor Pepsi feels like they have to cover their flanks. I would tell you that the grand ambitions of Canopy are incredible because they are, remember, Canopy, the Linton side is doing healthcare. The other side is doing, the Newland side, Constellation job, is doing, let's say, the pseudo-alcohol.
When someone so respected by Wall Street joins a cannabis company, what does that mean for?
Well, I've known Nelson for a very long time, and it means something. But remember, when Altria bought a big stake in Kronos, that was more significant, and the $4 billion the Constellation put in Canopy is more significant. Remember, it's who puts money in that matters more than who gets options to own.
All right, let's also speak about your real money column. Now, I've got a question for you about
Fire away.
Okay, so my question is, how can investors tell when a rally is based on facts and not
great.
hope?
I've been thinking all day that Apple, which is what I talked about, that maybe it's Warren Buffett buying Apple. Maybe it's Warren Buffett because it's been unstoppable. But there's this thing, Helene Meisler knows this better than anyone. She's our fabulous chartist, that when you see a stock levitate, that is often just pure multiple expansion. Now, we did a conference call. Remember, we have an 11:30 conference call tomorrow for Action Alert. We did a conference call which talked about how we screwed up on Facebook, which if Facebook went from 180 to 230 on nothing. So I want you to be suspicious of any rally based on nothing. And right now, the Apple rally is based on nothing. All we hear about is that it's worse in China than it was before. So be careful. I would say if you we're a trader. We're not traders of Apple. We like it long term. This is a clarion call to actually sell some because we don't know why it's going up. For instance, if you look at the big Dow stocks today, almost everything makes sense. Why is Nike going up? Okay, Nike is going up because Adidas is bad. All right? Why is Boeing going up? Well, because you've kind of discounted this over and over again. Why is United Technology going up? Because Boeing's going up. So, we have most of the big cap stocks. That's why I put those out there. There's a reason, but there's no reason for Apple.
But if I'm an investor looking at a stock that's rallying, how do I know that rally's based on hope?
Well, you take a look at the news flow and you take a look at the analyst reports. Is there earnings bumps? That's the key. If someone raises earnings, then you're good to go. That means that's not based on multiple expansion. If no one raises earnings estimates and the stock goes up, that's multiple expansion that I don't like. So if Apple's going to earn, say, 15, which is not, then suddenly, you should pay more because people were looking for, say, 13. But if they're saying 13 and there's no increase in that estimate, you're just paying more and more for the same estimate. That's a sucker's game, so be careful. And I do like Apple, but I'm just pointing out that multiple expansion means paying more for the same earnings estimate, and that's what you should be worried about. That's what we were doing with Facebook. That's how we got hurt.
All right, and this is something that everyone's weighing in on, so I got to ask you, Jim.
College admissions?
No, not college admissions, although yes, everyone is weighing in on that too.
Yeah.
But should we break up big tech?
No, and there's a lawsuit by Spotify, a company I like very much today, saying that Apple steers basically toward itself. You know what? That's the breaks of the game. Apple's got a great app store. It's their business. They can, Supermarket Kroger can put what it wants to at the front of the store, make it hard to find the other guy, and put the private label up. So, no, big tech shouldn't be broken up because big tech is actually innovative and has lowered costs for the consumer. As long as they've done that and not raised costs, I'm game. Don't break them up.
And are you ready for our investment education question of the day?
You bet I am.
All right, so this has to do with Rite Aid, this has to do with Tesla, this has to do with Volkswagen. And so my broader question for you is, what is the difference between healthy cost cutting and cutting jobs because of a deeper issue in the economy, in the company?
That's fabulous. Healthy cost cutting is supply chain management. You brought in Coupa software. You brought in ServiceNow for the front of it. You brought in Coupa software for the procurement. You brought in Salesforce to be able to make it so that you've got your salespeople much more productive, so you don't need all the salespeople. You brought in Workday to be able to make it so that your HR department costs less because it doesn't produce sales. Those are all good. You bring those in, that makes a ton of sense. If you're just doing a Kraft Heinz thing where you're just slashing everything and getting rid of things, no. I want growth to be more profitable. I don't want no growth to be no growth in profit either. So what you're looking for are companies that bring in great companies to be able to control divisions that have historically been dead weight losses. We used to call it Goldman. We were brutal back then. We used to call it dead wood. Who are the dead wood? Who are the people who produce no rev? Let's automate them and get them the hell out of there because automation doesn't have any health care. I shouldn't laugh. That's the way it was. Look, it was 33 years ago, and it's just a history lesson at this point.
And you're off to go interview Michael Dell?
Yes, and Michael is someone I've followed for many years, obviously one of the great visionaries of all time. And he's put together Dell, EMC. It's been amazing. Owns VMware, big stake. You cannot have any idols, but I do think he's done a lot of great things.
All right, and before we wrap, I just have to say we've got your AAP ActionAlertsPlus.com call tomorrow.
Talking about bottoms, how to spot bottoms, which I think is going to be very good. Obviously, we're going to talk about Home Depot with Jeff Marks, and I want everybody to be there because I think or sign up. Sign up. And look, it's like, what is it? It's like free to sign up and listen. You got to give us your email. Why wouldn't you listen? I didn't even give my investors at my old hedge fund this kind of insight. There you go.
All right, so you can find that at ActionAlertsPlus.com. Let's go talk about CVS on Action Alerts Plus.
Sure.